Insurance for Individuals, Business 506, Cal Lutheran University. Some objectives for today. By the end of this lesson, you should be able to describe the general characteristics of long-term care insurance, explain factors that influence the policy's premium cost, and understand how long-term care benefits are taxed. So, regarding long-term care insurance, the purpose of long-term care insurance is to provide a source of funds to pay for ongoing daily and monthly medical or custodial care when the insured is no longer able to perform activities of daily living. Long-term medical or custodial care might be provided at a skilled nursing facility, adult daycare facility, assisted living facility, life care facilities, nursing homes, hospital, or in the home. Life care facilities. These facilities require residents to pay an entrance fee and monthly service fees for meals, house cleaning, etc. When the resident becomes unable to live independently, he or she must then move to the assisted living units and ultimately to the skilled nursing facility. So it provides a smooth transition, going from being independent to assisted to totally dependent and in need of skilled nursing. Some alternatives to long-term care. One is personal savings. Individuals with significant personal savings can afford to pay for long-term care out of their assets. There is no magic number on that. A rough approximation is if the client has $2 million of investable assets, odds are that even in a protracted care situation, they won't outlive their assets. One thing that needs to be considered, actually the main thing is, if they are married, will they deplete the assets at such a rate their surviving spouse has a decline in lifestyle or is forced to sell off other assets and suffer as a result. Medicaid is the second point. This is a government program that provides long-term care to the medically needy. This program requires the individual to spend down their assets to a poverty level. And when they say poverty, they mean it. Typically down to $2,000 of liquid assets. So you're talking about being at the end of your rope financially. Some policy characteristics about long-term care. Long-term care policies are customized to reflect the insured's needs. Covered services can be tailored. That defines the coverage for skilled nursing care, intermediate nursing care, custodial care, and home health care. Benefit amount and duration. The insured can choose the benefit amount. For example, $200 a day for 5 years. And elimination or waiting periods can range from 0 to 365 days. Most commonly, you'll see 30, 90, 180, 365. These are similar to a deductible. It's the period of time that you'll have to be receiving care and paying for at your own expense before the long-term care policy kicks in and starts covering your expenses. Some common riders on long-term care policies. One is shared care. A couple with this rider can tap the unused benefit period for the spouse or of the spouse if it is needed. Inflation protection maintains purchasing power, and it can be a compound or simple factor. What you typically see there is 5% compounded or 5% simple interest. Waiver of elimination period for home health care. Waiver of premium. Policy premium waived when the insured is receiving benefits. So after they go on claim, they no longer have to pay the policy premium. Some of the policy triggers. Benefit funds will typically become available when the policyholder has one of two situations. The first being they cannot perform activities of daily living, and 2 of the 6 possible activities of daily living: eating, bathing, dressing, toileting, continence, mobility. Or the other situation is they suffer from cognitive impairment, dementia and Alzheimer's being the 2 most common types. That again, they could be otherwise healthy, but if they have Alzheimer's, that can trigger the benefits. Second point here, the policyholder's physician certifies the inability to perform 2 to 3 of the ADLs or cognitive impairment. So again, that's a benefit to the client. They don't have to go to the insurance company's hired doctor. They go to their own physician because that person will know them best. Last point here, condition is expected to last for at least 90 days. So not just something temporary, such as getting a joint replaced, a knee replaced, and being on your back for 6 weeks. It has to be a protracted situation lasting at least 90 days. The non-forfeiture option. A qualified long-term care policy is has guaranteed renewal by law and contains certain standard non-forfeiture options which offer the policyholder choices should the premium get raised. There's 3 possible choices. One is pay the new higher premium, keep the current policy and all the current benefits in place. Second is pay the prior premium, and that will buy a new reduced amount of benefits. So you still have the policy, but if the premium, for example, went up 20%, you could pay your old premium, but now you will only have 80% of your benefit that you had originally. And the last point is to cancel the policy and receive paid-up policy equal to total premiums paid. So for example, if you had 10 years of premium at $3,000 per year, you'd have $30,000 long-term paid-up benefits. Every qualified policy has an optional non-forfeiture option, which provides the policyholder a paid-up policy should the policyholder decide to stop making payments. This option can be cost prohibitive, very high cost relative to the rest of the premium. And second point, take a paid-up policy after holding the policy generally for 10 years. You'll receive the paid-up policy equal to total premiums paid. Talking about premium costs. Some of the factors affecting premium costs are age. The longer you wait, the more expensive it'll be. Underwriting factors, health at time of application, tobacco use, marital status, high blood pressure, history of coronary artery disease or stroke, all those things can be in there. And types of care covered, if it's stripped down to only cover care in a long-term care facility versus covering that and home care and adult daycare, again, types of care. Next is elimination period. We discussed that. Commonly you'll see 30, 90, 180, or 365 days. Amount of daily benefit. Most commonly you'll see that vary from $75 a day to $400 a day. It can be different, just depends on which insurance company you're working with. So again, read the policy information and sales material because they will have those items listed in there. Duration of benefit, 2, 3, 5, 10 years being most common. Older policies you may see lifetime benefit. Generally speaking, that has gone away in the industry. There was too much risk that was taken on by the insurance company to provide a lifetime benefit, so you'll be hard-pressed to find a company that still offers that today to new clients. And added riders, most commonly inflation protection. Here's a way to evaluate your long-term care policy when you're looking at comparing them. So you can use this format and these items here, and you can add in other ones that are relative. Starting first with financial stability and servicing history of the insurance company, and you could list that out. So not only the stability and servicing history, but also what's their track record for raising premiums on existing clients. That's another thing to look at. Next is services covered, so skilled care, intermediate care, custodial, home care, assisted living, adult daycare, and respite care also. Next item would be benefit amount and type of service, duration of benefits, waiting or elimination period, annual premium cost, and the tax treatment of premium payments and benefits. Continuing, are mental disease covered? Does the insurer provide care outside of the U.S.? If so, what countries qualify? What riders are available? And what is the associated cost of those specific riders? What's the enrollment age range? Does the client qualify? And also, carrier's history of raising rates. That was mentioned on the last slide, but again, it's very important. And specifically, raising rates on existing clients and any other factors. Let's talk about taxation of long-term care insurance. Taxation of policy premiums. There's deductibility of premium payments by employers and self-employed persons, and there are annual limits on the deductible employer or self-employed premium payments, and that's going to be based upon covered person's age, and the annual limits get adjusted for the cost of inflation. There is an IRS table that the client's CPA should be familiar with that will show what amount is deductible. Second bullet point, for the employee. Premiums paid by the employer are generally not considered as W-2 income to the employee. Continuing on, Individual. Premium payments by the taxpayer for qualified long-term care insurance is deductible as a medical expense, subject to the 7.5% AGI floor. And if the individual has an HSA, health savings account, the premium can be paid with pre-tax dollars subject to IRS rules. That goes back to the prior slide where we talked about based upon your age, a certain amount of premium can be deducted. Continuing on with taxation of benefits, individual policies, insurance benefits from qualified long-term care, per diem, and indemnity contracts are tax-free up to the daily benefit. Amounts received in excess of qualified care cost or above IRS index limits would be considered income. And on employer-provided policies, same as described above. It should be noted the tax treatment of long-term care benefits is similar to health benefit payments received for personal sickness or injury. So to sum up, we reviewed the general characteristics of long-term care insurance, some of the factors that influence the policy's premium cost, as well as taxation of long-term care policy benefits. Thank you for your time.